What's up, everybody? Michael Silva here. You're watching the Stock Market Brief Show. We got a lot to discuss today. We have divergences, seasonality, expected moves, and so much more. So strap in. Let's get into it. All right, welcome back, everybody. Hope you all had a good extended break from the overall markets. Taking a look at how the indices did today, you can see it was pretty red day overall, except for the NASDAQ 100, managed to come in unchanged to slightly up. The ones that got hit the most was small cap stocks, coming down almost 3% there for that indice. As far as the 11 sectors go, energy led the way along with technology. So both those two. Towards the bottom of the list, we had industrials and materials. Only 3 sectors out of the 11 were in the green. You can see over here, looking at a heat map, a lot of the bigger names, Apple, Microsoft, they were up on the day. NVIDIA remained flat, Google was flat, and then Tesla kind of stuck out at 4.72%. Now, this could just be just a bounce from its prior selling on the close of business last week, because when you run a scan here, this is an inside trading day scan. It allows you to see candlesticks that are, so if I were to draw out a candlestick like this, that was the prior trading day. Basically, it's searching for stocks within the S&P 100 that traded within that prior day's candle. That's what's known as an inside trading day. We talk about contraction, right? Coiling up. That is what I search for on these to potentially find setups. And you can see up here in the S&P 100, we had the bigger market cap names, Tesla and Meta. You have Walmart, J&J, AVGO, Costco, AMT, MO, which is Altura, that's a super staple, I believe it is, and then you have 3M there as well. And if I pull up a chart of Tesla, you can see what I mean here. You can see how this candle, it opened up at the low, right? And we closed basically at the high, but really we're just trading within that prior trading day candle. So this right here is consolidation. So if we start getting back above 260, it might open the door for a further pop, potentially even up to around this prior gap that we saw over here to around 280 to fill it to potentially 290. So we'll see how that resolves itself if we can get back above that 50-day moving average, as the 20-day moving average is starting to flatten out to potentially turn up if we can hold that level. You can see Meta over here too as well. They're not as big as a body, which I kind of prefer. You can see here on Tesla, you had a pretty large authoritative candle. So you had a large authoritative candle down, large authoritative candle up, large authoritative candle up there too as well. Where Meta, you can see that you saw, a large wick that's pretty authoritative, large authoritative, and then you have smaller bodies. So this contraction, to me, is something worth noting. So if we get back above 300, you might be able to play a pop to around that 305 if you're, a smaller term trader. Or potentially if we start breaking back down, you might be able to play that down to around that 285 marker there. So those would be the kind of levels that I'm watching. But when I trade these, I wait for the next day candle to break either the high or the low, and then that's when I start placing my entries or my shorts, and then that's also where I would start putting my stops at the other end of that too. Going into tomorrow, the DEX, we have a positive DEX, so still has a bullish bias. We had one on Friday's close too as well, and we ended down, but I will say that the Qs did finish up, so that is something worth noting. So the slightly bullish bias as far as going into tomorrow's trading day. Now, when it comes to seasonality, something to pay attention to on occasion, right, of what assets perform good during certain times of the year. And the dollar is actually one that performs really well in September, and we'll tell you why I'm going over the dollar, because when the dollar performs well, typically you can have other assets perform not that well, such as the S&P 500 could finish down. So if I were to pull up a seasonality chart for the last 14 years or so of the UUP, you can see 71% of the time, okay, for UUP, that's the dollar fund, if you want more data, that finishes in the green. So if this finishes up the last 14 years in the green, what does the SPY do for the last 14 years? Well, 43% of the time it finishes in the green, so less than half. Now, if we extend that out even further to the last 31 years, try to get as much data as we can since January 1st, 1993, you can see here too as well, only 48% of the time it's September, it finishes in the green, which is actually one of the lowest months there based off of seasonality. So we have a strong dollar month, typically low seasonality, a weaker month here in September. So it's something that we need to be at least aware of after we saw a pretty nice bounce in the overall markets. Now, if we take a look at the 10-year yield, we've been talking about how it was pulling back, right? If you watch our prior videos, boom, it was pulling back into this trend line. So be careful if we start to get a bounce from these levels, because it could put pressure on various equities. And we saw that. We saw a 2-day bounce, very strong move over there, which brought down obviously the TLT, right? If we use this as the proxy to look at bonds, something to pay attention to. If we start getting back at above 97.5, perhaps this could be a head and shoulders, inverse head and shoulders that is forming, and that 97.5 is the neckline to bring us back up to around that 102 marker. Otherwise, if we start breaking through 92.50, that trade idea or that pattern would be invalidated. Now, as this is going on, you can take a look at the 10-year and 2-year yield curve, which everyone's starting to say, like, these don't matter. Yeah, they do matter, and I'll tell you what, every single time that they invert, you have somebody saying, no, this time is different, it doesn't matter anymore, until it matters, right? We don't know the timing of it, but we know that it's not healthy for the overall markets when you have an inverted yield curve. And that's not just the 10-year, 2-year yield curve. We have the 10-year, 3-month yield curve. And something that we pointed out a while ago is when you look at the yield curve and you look at the S&P 500 below us, when the yield curve actually gets deeper into inversion, right, under the 0 marker, you actually see the S&P 500 rally. Okay, so it gets deeper into inversion, the S&P 500 rallied. Deeper into inversion, the S&P 500 rallied. Deeper into inversion, the S&P 500 rallied. On the flip side of that, if the yield curve starts uninverting, starts moving up, it puts pressure on the S&P 500, right? Goes up, pressure on the S&P 500. Up, pressure on the S&P 500. Up, pressure on the S&P 500. So one might think that throughout time, if this starts cranking up, it could spell out bad news for the overall markets. Now, if I take a look at a longer term chart, where we can look at the 10-year, 2-year, and also the Fed rate. So the 10-year, 2 years here, the Fed rate's down here. What you'll notice is when we uninvert, it tends to be where we have problems in the overall market. So we uninverted here, bam, market. That was the dot-com bubble bursting, right? We uninverted here, the great financial crisis. Not to say that's going to be the same case here or anything, but what I am noticing also is these are during rate pauses, and then we start seeing the damage on the unwind, the problems when we actually, not at the pause, but when we start to reduce the overall rates. So you can see here the Fed funds rate started dropping down right around this area, and that's right around the uninversion. That's where we ran into problems. You can see right here the same situation, okay? Uninverted. You have right here when the Fed started lowering rates, all right? Actually, pretty same situation right over here. We actually had a small inversion right there. This is leading up into the pandemic, and this is also happens to be where the Fed started reducing rates too, right around the same area. We saw that big flash move to the downside over the pandemic. Well, we are here, and the Fed does say that they're going to hold higher for longer, so we may go out for a ways sideways unless there's something happens to the point where they have to reduce rates, and that could be when the yield curve uninverts. And I just mapped out a couple levels, but I mean, this thing fell 58% during the dot-com, 51% in the dot-com, 58% during the great financial crisis. So if we were to fall 50% from the high, that would bring us down to around 2,500, which would be a pretty crazy move in the overall markets, but that would still be higher than where we were at the low of the pandemic. So is that possible? I don't know. I would imagine that some sort of event has to take place in order to see that type of wicked type of sell side activity, but it is something to just obviously pay attention to. Now, one of the divergences that I want to call out here is looking at a ratio up here. This is a ratio line of the SPX. Okay, SPX, because we're talking a lot about bonds, right, and yields, TLT. So it's a ratio line of these two products, meaning that if the line goes up, it means the S&P 500 is performing better than bonds, right? If it goes down, that means that bonds are outperforming the S&P 500, which is you typically see that in a risk-off type situation, or could see it in a risk-off situation. However, there is something interesting when you see these like potential pivot points in the market. You can see small divergences that build out for a couple of weeks, could be a little bit longer. So I'm calling it out now where the ratio line is moving up higher, but the S&P 500 is not quite matching that level, okay? So what we'll notice here in the past, where you get the higher high in the ratio line, you get matching highs here in the S&P 500, and it could sell off, right? The same thing here, the same thing here, the same thing happened here, and now, we're kind of coming into that again. So we had this strong move up, the ratio line, right? S&P 500 is outperforming bonds to a rapid move, but bonds are also performing very well. And we know that, when you have yields that move at a rapid rate, it could put pressure on growthy names. So this is just a subtle divergence. Doesn't mean that it's going to come crashing down. In order for this divergence to go away, you'd want to see S&P 500 back above 4,600. Okay, that would make the divergence go away. But even if it comes up and has a matching high, and this thing is still diverging, it's still something to be obviously aware of. Now we would need some sort of catalyst. The only catalyst that we have really this week, we have the S&P Global Composite PMI final. We have ISM Services PMI. That's about an hour, about 30 minutes, into the market open come tomorrow. Not all that much stuff going on, but a lot of Fed talk on Thursday. That is Thursday. So tomorrow, September 6th. So that'll be at 7 a.m. And then the next day, Thursday, we'll see that. Sorry, I got the 3-day weekend, got me all confused there. Now, overall, if we take a look at what the Fed is currently potentially going to be doing based off of Fed futures, the Fed funds futures, you can see here September 20th, there's about a 92% probability that we are going to keep rates the same. I don't see that the Fed would raise given this current condition, but who knows at this point? I think the bigger one to pay attention to is what changes out here in November. Because if I do go out to there is a little bit more confusion how there's, about 50% that we're going to keep it the same, but there's also about a 50% chance that we are going to be raising it 25 basis points. So what you'll really want to pay attention to as time progresses is how this changes here in November. If they're going to, if we're going to start to see this lift up, or if we're going to start to see this lift up, meaning that we're going to get another rate hike. And we should get more information and insight into that September 20th when the Fed comes out. But you never know. We might get some more Fed talk that leads us into a certain direction there. If we take a look at the dollar was also up huge on the day. This one came up to that 105. So this thing is just on a monster move, which is obviously could be what's putting pressure on the S&P 500. It's definitely helping out what's putting pressure. You have yields up, dollar up. The markets don't really like that. And you can see gold is not liking that as well. It was down almost 1% on the day. You have copper that was slightly down on the day, and you're getting some wicked type candles here, okay? So you have a long topping tail up top, which could have marked a reversal, but now we have another candle that has a long lower wick, which could mean that we could press higher. So if copper starts coming off, that could spell, bad news for the S&P 500, but we'll map out some key levels as to what that may look like. Other assets that have been doing quite well is oil. You can see this thing has just been on a monster streak to the upside. So this is not something that I would be looking to chase, but what we did say was we had that golden cross down here. You can potentially pull back into it, right? Flagged out, and we saw a very strong move from that level. And this is actually moving with the dollar moving up too as well. So you can see the RSI is getting a little frothy here. So give it a little bit of time. Just be aware that it's been a monster run. You don't want to really FOMO into this type of stuff. From a positive note, we're looking at the summation index. We did have the parabolic star tick over there on the last trading day of last week. So now it's 2 days above. So we're identifying a potential change in trend taking place after this rally. The same thing goes with the NYSE summation index. We had that potential change in trend right here, despite seeing a pretty, red day today. But we're back above the summation zero line, and the parabolic star is upticking, right? We bounced heavily from oversold conditions. So we could be potentially just coming right back down where this kind of just duels around sideways, but until the parabolic SAR upticks back over it, right, to identify potential another change in trend, as it stands right now, that was a bullish crossover, and this was as well. Okay, if we take a look at the S&P 500 on the weekly time frame, down slightly on the week so far, nothing new there, but we're just trading obviously within this. One of the big levels we pointed out the prior week on the weekly candles where you had a high and a low, it acted as support, so resistance, acted as support, acted as resistance, and we came into this area on the prior week. So really, to be more bullish, you would want to be above that level and clear that from a weekly closing perspective. If we start pulling down further, look at the weekly 5 EMA. This could be coming up to around that 44.80 marker, and that still is inclining at this time. It's not until we get underneath it and it starts curling over, which would be a little bit more bearish. And you can see this here on the daily time frame for the S&P 500. Right, we had a closing low, so we closed at the low of the day, which is not the greatest sign. So if we start continuing to press down, we're still above the quarter-to-date anchored VWAP, okay? And we're above the anchored VWAP from this prior high, the swing high. So if price were to pull down at this area, around this area, 445, 446, that could act as a level of support. And if that is going to hold a support for this week and we come down there, this could be a potential area to look to play for a move back up if you are bullish, okay? Now, looking at this from a 15-minute perspective, we can get a little bit more intricate. One thing to note is, overall, this, after a very strong run-up, this does look kind of like it's kind of rounding off, like it's going to be potentially breaking this little, rounding top to potentially come down here to the lower weekly expected move. That lower weekly expected move is at 446.31. Okay, remember, 68% of the time, we finish within those expected moves. The daily expected move for tomorrow is at 446.96, so very close to each other. So if we get some more continued sell side, this level would also line up with the quarter-to-date anchored VWAP. So tomorrow comes and we open down here, we would already have met the expected move on the week already, and we would be coming into confluence area of support. So I'd be looking at that area if you're looking to potentially buy the dip. However, I want to reiterate this. If you're looking at this as far as the perspective of trend goes, the 5-day moving average, we close below it, okay? But it is inclining. So what does that mean? It means that technically it's a break, which is bearish, okay? So bearish. All right, bearish. And then it's inclining, which is, still bullish, right? So I would say at this point it's bearish, but with caution, meaning that if we start getting back above it, it'd be, bulls could be in charge. And if I look at this from just a price action perspective, what you can see here is price is just really coiling up, right? We move strong up. Now price is starting to contract. So a strong break of either direction could produce an expansionary type move. So the expansionary type move to the downside, all right, I don't really short all too often. Sometimes I do, but lately I just haven't even bothered. I've been looking more from the long perspective. I would be looking to see how price forms down here if we get a break. I wouldn't necessarily try to catch the move down to here. It's just not how I'm currently set up to do. But that's kind of what I'd be looking at. However, if price does come down here, understand that the 5-day would start to flatten out most likely and potentially start heading down. So even if we would come down here and start bouncing back up, these levels can act, right? These breaks can act as potential. What happened to support can act as resistance. So you got to be aware of that. Now, from a bullish perspective, if you're like, I don't really want to play the dip, I'd rather just wait for price, to do its move and get back above the 5-day moving average, something like that. The month to date, which it's now September, you can clearly see we broke it. It acted as resistance, resistance, resistance. So what you want to see from a bullish perspective, if you want to make this very simple, right? Price back above the month to date anchored VWAP sets us up to go hit that upper weekly expected move. It's as simple as that. Those would be the levels that I'm watching going into tomorrow's trading session and throughout the week if we don't tag them right out of the gate. That's all I got for you. See you later.